Properly recording equity for an owner is crucial in a set of accounting books. At any given time, I'd really like to know how I'm doing with my investment. The equity accounts are how we will track this in QuickBooks. Let's go to our balance sheet. On the bottom of our balance sheet is where we'll find our equity accounts. Now, of course, keep in mind that there's always many ways that you can track things. I'm going to use a common layout in this example. Let's pretend first that we have only one owner. In my equity account, I have my original opening balance. Traditionally, this is when I set up the company initially. I'm showing exactly how much money that I gave to the company as a startup amount or the seed money. The second item, the owner's investment, reflects what I've put into the company from that point forward. Many times we like to track our initial investment separate from any funds that we put in after the fact. Whether or not I track this has a lot more to do with how I budget and what my individualized situation is. Nonetheless, in this case, I'm tracking my investments separately. Our third account is the draw account. This is when I pull money out of the company in lieu of payroll. Whenever an owner has money pulled out or personal expenses that might be recorded, we'll use their draw account as the way of recording those entries. Finally, we have the overall equity account. This particular account is the original retained earnings account in QuickBooks. Now remember, retained earnings means everything the business has made or lost throughout the years, excluding the current year. Our current year is in net income. My year to date is under net income. All prior years are rolled up into the owner's equity. Let's talk just a little bit more in depth about these by going to the chart of accounts. In our chart of accounts, I'm going to go to our equity section. When I go down to the equity section, once again you'll notice the same accounts. My opening balance, owner's investment, owner's draw, and equity. The opening balance is the offset account during the setup of the company's books. Very often, this is the initial investment by the owner. The second is the investment by the owner from the running of the operational aspect of the business. Now there's two schools of thought here. Some owners prefer to let this amount accumulate over the years so they're conscious about how much they've had to put into the business. Others just assume have it closed out into the retained earnings account, which in our case is called the owner's equity account. Again, discussion with your accountant and the owner of the firm is necessary to determine which way that you want to go. The draw account is traditionally zeroed out each year. We'll close this out into our retained earnings and start a fresh account the following year. This allows the accountant to very quickly see exactly what draws the owner has taken. Recorded properly, this is a very important tax planning tool and also a very important tool to ensure that entries are recorded correctly. Now what if there are two owners, partners? What I'll do in this case is double the actual accounts I see. The accounts I see here, owner's investment, owner's draw, owner's equity, may become partner 1 investment, partner 1 draw, partner 1 equity. Then I'll set up a second series of accounts, partner 2 investment, partner 2 draw, partner 2 equity. I'll keep an actual retained earnings account, but I'll always split that to the individual partners so that any given time they can see on the book what share is theirs. We'll show an example of multiple partners and how to close those out in our next movie.